The World Bank has revised down its GDP forecasts for the region, projecting developing East Asian growth at one of the lowest rates in 5 decades for next year. Still, the region's emerging market economies look set to outshine their peers elsewhere in the world as they recover from the deep shocks caused by the COVID-19 pandemic. The World Bank's latest projection out today sees developing East Asia and the Pacific wrapping up the year with a 5% growth. That's a little lower than April estimate. For 2024, the region is likely to see an expansion of 4.5%, also below the previous forecast. With the exception of some Pacific Island nations, economies in the region have largely come off the rock bottom level seen in 2020, and the expansion is poised to continue, although at a slower pace. Stripping out China, GDP in developing East Asia and the Pacific is predicted to rise 4.6% this year and 4.7% in 2024. Goods exports have been on a decline, but the weakness is somewhat offset by tourist arrivals, which are getting back to near pre-pandemic levels. The revival has helped the services sector in Thailand, for example, a key beneficiary of the influx of Chinese visitors. External threats, though, are casting a shadow on developing Asia's near-term growth outlook, from the elevated core inflation to a labor market crunch in major economies. Plus, global financial conditions are expected to remain tight. Domestic factors also at play, especially with the mounting debt pressure, a legacy of the pandemic. In the past 13 years, debt levels have soared across the public and private sectors. Household borrowing is notably higher in China, Malaysia, and Thailand. In the medium to long term, the World Bank says development of services will be critical to the region's overall expansion. In recent decades, manufacturing has been the backbone of Asia's rapid boom, but the bank says the services sector plays a growing but often underappreciated role as a key growth engine and jobs creator. And to delve into this latest report, we are joined today by Aaditya Mattoo. He's World Bank's chief economist of the East Asia and Pacific region, and he's live in Washington, D.C. Good to have you on board, Aaditya. Let's talk about the economic landscape first. Now, despite the efforts by Beijing, turning things around is proving difficult. Do you see dismal economic landscape then for the region for as long as it relies on China for trade and services?
I think you're absolutely right that China is very important for the region. A simple calculation we did showed that a 1% change in growth rate in China changes the growth rate in the rest of the region by 0.3%. The links are strong through trade, through investment, and through also movement of capital. So China matters. I don't think the outlook is quite as dismal as you made it sound, Olivia. I think there are tremendous strengths in the region. As I think you noted, it is still growing faster than most other parts of the world and shown remarkable resilience in the face of shocks. As you have probably seen, countries like China and Vietnam output today is as much as 20% higher than pre-pandemic levels. And it's not just these two countries. Malaysia, Philippines, Indonesia, output there is about 10% above pre-pandemic levels. And they're growing. Growth is continuing. It is true that it's slowing down.
Aaditya, outside China, your report suggests that the world is headed for a slowdown. You're looking at a 2.1% GDP forecast this year, down from last year's 3.1%. And you also mentioned financial tightening, protectionism measures, muddying the waters in Asia Pacific. Can you explain your thinking here?
The first key point the report makes is that the fortunes of the countries outside China is largely being shaped by external developments. 2023 was a hard year. Global growth was slowing down. Financial conditions were tight. And they suffered, and that's why growth was relatively low. Next year, we believe that the world will recover, and because inflation is more under control, financial conditions will ease. Therefore, we slightly upgrade the forecast for the rest of the region. I forget you asked me another question.
Well, I'd like to zoom in on domestic factors then, shaping the near-term growth. Macroeconomics not looking very conducive, not to mention the legacy of public and private debt, fiscal policy become less expansionary while monetary policy tightened. What does it mean for economic recovery then, this shift in structural balance?
It is absolutely true that one legacy of COVID is this amplification of debt. Government debt, corporate debt, household debt. So across the board, we're going to see, household debt inhibiting consumption, government and private debt inhibiting public and private investment. So these are real concerns, and there isn't a lot of fiscal space for governments to provide the kind of stimulus that they might have wished to. We argue in this report that for most countries now, they do need to turn to deeper reforms to unleash their tremendous potential. And we point to the services sector, as you noted in the introduction. This is a sector which remains relatively protected, and this is a sector that offers remarkable opportunities because of the digital revolution that we see unfolding.
Yeah, I'd like to also circle back on that. You did mention that services for development being a virtuous cycle of opportunity and capacity. Do elaborate on this. How do reforms in the services sector lead to enhanced productivity and jobs?
First thing I should note is that the services sector already accounts for more than half of output and half of employment in the region. This idea of productivity pessimism about services is completely unfounded. Over the last decade, the services sector has contributed more to labor productivity than manufacturing. And even services trade and services FDI are in fact growing faster than manufacturing trade and manufacturing FDI. Now, the region still limits entry and competition in services sectors, limits the possibility of cross-border trade. And new data we were able to get for this report showed that, for example, in the Philippines, the services firms have been able to adopt new technologies much more so, new digital technologies much more so than manufacturing firms. And that's translated into big increases in productivity. In Vietnam, the reforms that they implemented over the last decade have actually boosted productivity, not just in the services sectors, but also in the manufacturing sectors that use these services. So we don't really think of the services sector as an alternative. We see it as a source of economy-wide growth. But we also recognize that there are big policy reforms that are needed. The countries still have restrictions on foreign investment. The Philippines has implemented big recent reforms. Indonesia is in the process of implementing big reforms. So this is a positive sign that countries are beginning to recognize the potential of allowing greater freedom of trade and investment in services so they can benefit as they have from open trade and investment in manufacturing.
Well, positive signs indeed. Thank you so much for sharing your insights today. Aaditya Mattoo, Chief Economist of the East Asia and Pacific region at the World Bank.